All right, stop scrolling for a second because something just snapped in the silver market and it happened fast. We're talking about a minus 37% move in just 48 hours. Roughly $1.4 trillion in paper value vanished before most people even processed what was going on. And now JPMorgan is out warning that silver could slide all the way back toward $50 an ounce. That's about 50% downside from the recent $120 highs. This isn't some distant forecast either. This just happened, and it matters right now because silver just showed you how fragile it really is. Stay with me because I'm going to show you what actually broke, why this pattern repeats, and how you can spot it yourself before the crowd does. Before I explain what caused this, let me teach you something most people don't fully understand about markets like silver. Silver isn't just a metal, it's a leverage playground. You're not just trading bars and coins, you're trading futures, options, margin, and momentum. Think of it like a crowded elevator. As long as it's going up, nobody cares how many people are inside. But when it stops suddenly, everyone feels the weight at the same time. That's what leverage does. It amplifies the move up, but it also makes the move down violent. And when liquidity tightens, silver doesn't gently correct. It air pockets. Now, when traders talk about leverage in commodity markets, they're really talking about borrowed exposure. You put down $10,000, but you control a position worth $100,000. When that position moves 1% in your favor, you don't make 1% on your 10,000. You make 10%. That's the beauty of it. But here's what they don't tell you in the sales pitch. When that position moves 1% against you, you lose 10% of your actual capital. And if it moves 10% against you, you're wiped out completely. Your broker closes your position, keeps what's left of your money to cover their risk, and you're done. So, what does that tell us? It tells us that leverage markets don't move like spot markets. They move in waves of forced action. When prices rise, more people can borrow more money against rising collateral values. That buying pressure pushes prices higher, which lets even more people lever up. It's a feedback loop, but it works in reverse too, and that's where we are right now. If this is making sense, drop a comment below and let me know what you're seeing in your corner of the market. I read every single one. Now here's what's actually happening under the hood. Silver didn't casually drift higher over the past year. It went parabolic, up about 260% year over year. Let me put that in perspective. If you bought silver at $45 an ounce in early 2024, you watched it climb all the way to $120 by late January 2025. That's not a bull market, that's a mania phase. And that kind of move doesn't come from long-term stackers quietly accumulating physical metal in their safes. That comes from speculative capital, momentum traders, and leverage futures piling in because price action looks unstoppable. So, what happens when you get that kind of vertical move? Margin requirements creep higher. Exchanges don't like risk. When volatility spikes, they force traders to put up more cash to hold the same positions. That's not a conspiracy. That's risk management, but it has consequences. Higher margin requirements mean less leverage available. Less leverage means less buying power. And when buying power starts to dry up, liquidity gets thinner. Bid-ask spreads widen. It gets harder to move size without moving price. And then you get a trigger. Here's the thing. The trigger doesn't even have to be bad news. Sometimes it's just price stalling. Silver hits $120 and it sits there. It doesn't break higher. Momentum fades. And when momentum fades in a leverage market, the whole structure gets fragile. Because all those traders who bought at 110, 115, 118, they're not in those positions because they believe in the long-term fundamentals. They're in because the chart looked good. When the chart stops looking good, they leave fast. That's when forced selling starts. Futures get liquidated, stop losses get hit. Algorithms that were programmed to buy momentum flip to sell programs. And suddenly what looked like strength turns into a cascade. I'm talking about real, mechanical selling pressure that has nothing to do with whether silver is actually worth $120 or $80 or anything else. It's just math. Positions getting closed because margin clerks are making phone calls. But here's the part that should make you nervous if you're not paying attention. Once that cascade starts, it feeds on itself. Lower prices trigger more margin calls. More margin calls force more selling. That selling pushes price lower again. It's a chain reaction. And that's how you get a 37% crash in 2 days. from $120 to roughly $75 in less than 48 hours. That's not a market expressing a view on supply and demand. That's a market expressing liquidation pressure. Now let me show you what very few people are talking about. This wasn't a fundamental collapse. The physical silver market didn't suddenly discover a massive new deposit. Industrial demand didn't evaporate. Solar panel manufacturers didn't stop buying. None of that changed in 48 hours. This was mechanical, and that means it can overshoot far lower than feels reasonable before it stabilizes. Because when you've got leveraged players getting forced out, they don't care about value. They care about survival. They sell at whatever price clears their position. $75? Fine. $65? Whatever. $50? Done. The price that stops the bleeding isn't the price that makes fundamental sense. It's the price where all the forced sellers are finally gone. And here's what makes this even more important to understand. The people getting liquidated right now aren't evil. They're not stupid. They're just over-leveraged. They saw a rocket ship and they wanted a seat. Can you blame them? Silver was the best performing asset in the world for months. Every dip got bought, every pullback was shallow, until it wasn't. The market doesn't ring a bell at the top. It just stops going up. And if you're holding a leverage position when that happens, you don't get time to think it over. You get a margin call. And you've got hours, maybe minutes, to either add cash or get sold out. This is the exact same playbook silver has run before. And I mean the exact same playbook. Go back to the late 1970s. Silver was trading under $2 an ounce in 1973. By January 1980, it hit $50. That's a 2,500% move in less than 7 years. Massive run, massive enthusiasm. The Hunt brothers were trying to corner the market. Retailers couldn't keep physical silver on the shelves. Magazine covers were calling it the investment of the decade. And then, what happened? A brutal mid-cycle drawdown of roughly 50%. Silver fell from $50 back to the mid-20s in a matter of months. Everyone who bought the top thinking it was going to $100 got destroyed. But here's what people forget. That wasn't the end of silver. It was a reset. Or look at 2011. Silver rockets from $18 in mid-2010 to just under $50 in April 2011. Another parabolic run. Another wave of euphoria. Sentiment goes vertical. Reddit threads are full of people calling for triple digits. And then it loses about half its value in a matter of months. By late 2011, silver is back in the mid-30s. By 2013, it's in the 20s. Same pattern. Late buyers get punished. Early buyers survive if they didn't lever up. And patient capital eventually gets another opportunity. Every time this has happened, the setup is the same. You get a macro catalyst that makes sense. In the 70s, it was inflation and currency instability. In 2011, it was quantitative easing and fear of dollar debasement. In 2024 and 2025, it was a combination of industrial demand from green energy, persistent inflation concerns, and geopolitical instability. The fundamentals are real, but fundamentals don't determine short-term price action in leveraged markets. Positioning does, margin does, liquidity does. And when those things reverse, the fundamental story doesn't matter for weeks or even months. The market has to clear the excess first. Here's the lesson that keeps repeating. Zoom out and you see the larger story. Silver doesn't die in these moves. It resets. The people who survive these cycles are the ones who understand that price and value are two different things. Price is what the market will pay you today. Value is what the asset is worth over time. And in leveraged volatile markets, those two things can disconnect violently. Your job as a participant, whether you're a trader or a long-term holder, is to know which one you're dealing with at any given moment. Right now, we're dealing with price. Pure price action. Liquidation-driven, momentum reversed, leveraged unwind price action. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. What about manipulation? I know that's the first thing some of you are thinking. What about the big banks shorting silver to keep it down? What about the concentrated short positions we've heard about for years? What about physical shortages? What about the fact that there's way more paper silver traded than actual physical silver exists? Could JPMorgan be wrong about their $50 target? Of course they could. Banks aren't prophets. They've been wrong before. They'll be wrong again. But here's the thing. You don't need a conspiracy to explain this move. Leverage explains it. Liquidity explains it. Momentum reversal explains it. I'm not saying manipulation doesn't exist in precious metals markets. There's been enough fines and settlements over the years to know that sketchy behavior happens. But trying to trade based on conspiracy theories is a losing game. You can't predict when the manipulation is going to happen or when it's going to stop. You can't front-run a market rigger if you don't know their positions or their timeline. What you can do is focus on what you can actually measure: volatility, margin behavior, price structure, open interest changes, volume patterns. Those tell you far more than headlines about secret manipulation ever will. Could this be different because of industrial demand? Could electric vehicle production and solar panel manufacturing create a floor under silver that didn't exist in past cycles? Maybe. That's a legitimate argument. Industrial demand is real and it's growing. But industrial buyers don't panic buy on the way up, and they don't panic sell on the way down. They hedge, they contract, they move slowly. So, while industrial demand might put a floor under silver at some price, it's not going to stop a leveraged unwind from running its course. The question is where that floor is. Is it at $90, $70, $50? Nobody knows for sure, but the mechanics don't care about the floor until they find it. There are probably three types of people watching this right now. First, you're already long silver, and you're feeling that pit in your stomach. Maybe you bought physical at $100, thinking it was going to $150. Or maybe you're holding futures and you're watching your account value drop by the hour. I get it. This hurts. The key for you is survival, not heroics. If you're leveraged, respect your risk. Don't average down into a liquidation event hoping it turns around. It might, but it also might go lower first. If you're holding physical with no debt against it, you've got time. You don't have to do anything. But even then, be honest with yourself about your thesis. Are you a long-term holder who believes in silver over years? Or were you momentum chasing and now you're stuck? There's no shame in either answer, but the strategy is different depending on which one is true. Second, you're on the sidelines thinking this is finally your chance. Silver's down 37% in 2 days. It's got to bounce, right? That might be true. Oversold conditions do lead to bounces, but timing matters. Catching a falling knife feels smart until it isn't. You don't get extra points for buying the exact bottom. If silver goes to 70 and bounces to 85, you can still make money buying at 80. You just need confirmation that the selling pressure is done. What's that confirmation look like? Stabilization. Multiple days where silver trades in a tight range without collapsing lower. Volume drying up on the sell side. Maybe some positive divergence in the momentum indicators. I'm not saying wait for it to go back to 100. I'm saying wait for evidence that the forced selling is over. Third, you're a long-term believer who doesn't care about the noise. You've been stacking physical for years. You see silver as insurance, as a store of value, as a hedge against currency debasement. And you're planning to hold through whatever happens, because your time horizon is measured in decades, not days. That's valid too. Actually, that's probably the healthiest relationship you can have with precious metals. But even long-term positions benefit from understanding cycles, because if you know we're in a liquidation phase, maybe you don't add to your stack right now. Maybe you wait a month or two to see where this settles, or maybe you do add, but you do it slowly, averaging in over time instead of going all in at once. Being a long-term holder doesn't mean you have to ignore price. It just means price doesn't dictate your entire strategy. The universal rule here, no matter which category you fall into, is simple. Price always moves faster than conviction. You can be right about the long-term direction and still get hurt in the short term if you're positioned wrong. That's not a flaw in your analysis. That's just how markets work. So, here's what I want you to answer in the comments. Which type are you? Are you holding and hurting? Are you waiting for confirmation? Or are you a long-term stacker who's tuning out the noise? Let me know, because I want to understand where my audience is on this. Now, here's where I stand personally. I'm not bearish on silver long-term. I think the industrial demand story is real. I think the inflation concerns that drove part of this move haven't gone away. I think there are legitimate reasons to own precious metals as part of a diversified strategy. But I'm not chasing it here either, not at $75, not until I see stabilization. I'm watching three things very closely, and I'll tell you exactly what they are. First, I'm watching whether price can stabilize around that $95 to $100 zone without explosive volatility. If silver can hold above 95 for a week, maybe 2 weeks, without another leg down, that tells me the worst of the forced liquidation is probably over. It doesn't mean we're going straight back to 120. It just means the selling pressure has exhausted itself. That would be a constructive sign. But if we can't hold 95 and we slice down through 90, 85, 80, then we're probably headed toward that JPMorgan target of 50. And at that point, you're looking at a much deeper retracement that could take months to resolve. Second, I'm watching whether we get a deeper deleveraging that pushes us into the $70 to $80 range. That might sound contradictory to what I just said, but it's not. Markets don't move in straight lines. We could bounce from here to 85, fail, and then make a lower low into the 60s or 70s before we're actually done. That would complete the liquidation cycle. It would flush out the last of the weak hands, and it would set up a cleaner base for any future move higher. I'm not rooting for that. I'm just watching for it. Because if it happens, that's probably your best long-term entry point, not the first bounce, the final washout. Third, I'm monitoring whether physical premiums and volatility cool instead of expanding. Right now, if you go try to buy physical silver from a dealer, you're probably paying a premium over spot price. That premium reflects the disconnect between paper and physical markets. If that premium starts to compress, if it gets easier to buy physical near spot, that tells me the panic is fading. People aren't hoarding. Supply is meeting demand. That's a healthy sign. But if premiums expand, if physical becomes harder to get, even as paper prices are falling, that creates a more complex picture. It might mean the paper market is overshooting to the downside, while the physical market is holding firm. That's happened before, and it creates opportunities, but also confusion. Based on my analysis, this move was mechanical, not emotional. It was structural, not fundamental. The fundamentals didn't vanish in 48 hours. Solar panels still need silver. Electronics still need silver. Investors still want inflation hedges. None of that changed. What changed was positioning. What changed was leverage. What changed was liquidity. And when those things change in a commodity market, price can disconnect from value for weeks or months, while the excess gets cleared. That's where we are. This is the clearing process. If history rhymes, and I think it will, this shakeout clears excess before any durable base forms. The question is how long that takes and how low it goes before it's done. I don't have a crystal ball. I can't tell you we bottom at $68 on March 15th at 2:30 p.m. Nobody can. But I can tell you that every major silver bull market in modern history has had at least one violent correction that scared out the weak hands before the next leg higher. 1979 to 1980 had one. 2010 to 2011 had one. And now, 2024 to 2025 is having one. The pattern repeats because human nature repeats. Greed, fear, leverage, and liquidation. Same cycle, different decade. Now, I'm not a financial advisor. This is not financial advice. Everything I've shared here is my personal analysis and opinion. You need to do your own research. You need to understand your own risk tolerance. You need to make your own decisions based on your own situation. I'm just showing you how I'm thinking about this, what I'm watching, and what patterns I'm seeing. Take what's useful, ignore what's not, and build your own framework. If you made it this far, you're not just watching the market, you're studying it. And that mentality, that willingness to go deeper than the headlines, that's what separates people who survive these cycles from people who get chewed up by them. You're asking the right questions. You're looking at the mechanics, not just the price. You're thinking about leverage and liquidity, not just whether silver is a good long-term hold. That discipline will serve you well, not just in silver, but in every market you ever touch. So, do me a favor. If this breakdown helped you understand what's actually happening in silver right now, hit that subscribe button. Share this with someone who needs to see it. Leave a comment with your thoughts, and stay sharp out there. Because the market doesn't care about your thesis. It doesn't care about your conviction. It only cares about your positioning. Know the difference between price and value. Respect leverage. Understand liquidity. And never, ever assume that what's happening today is what will happen tomorrow. Markets change. Your job is to change with them. I'll see you in the next one.